Good evening, my host.
Good evening, Prof.
Please, can you confirm whether you can see my screen?
Yes, can see your screen and can hear you.
Thank you, ma. Good evening, students. You're welcome to our class on this platform. I want to believe we are catching up as the lecture progresses. I want to believe that. I want to also believe that as we are doing the lecture here, you are taking your time to revise whatever we have covered so far. Okay, it's very, very important. Make sure you don't pile up your notes. Revise them as we treat them here so that you can master them. All right. So far, so good. We have covered cost of capital. We have covered investment appraiser. And basically, under investment appraiser, we have covered the NPV aspect. And of course, we have been able to treat the lease or buy decision aspect of capital budgeting, otherwise known as investment appraiser. Today, we shall be moving a step further to look at a more advanced way of investment appraiser, which is the adjusted present value approach. That is what we're going to discuss on this platform today. After that, after covering this, we should be going to business evaluation, then we go to merger and acquisition, then we can also look at other aspects like portfolio theory and the CAPM and the option pricing theory before we cap it up with interest rates and currency risk management, otherwise known as hedging. Okay, having said that, let's quickly go to business of the day, believing that you already know the rules and regulations guiding the conduct of our activities on this platform. So needless for me to start repeating those ones, as I believe we are all still like here. We do have freshers among us. So make sure you abide strictly by these rules so that we can have each free lecture. Thank you. Okay, like I said, today we want to look at the adjusted present value approach to project evaluation. What do you mean by the adjusted present value approach? The adjusted present value approach is a method of investment appraiser which is used when a business entity is considering an investment in a project that will have a significant impact on the business risk and the financial risk of the company. Okay. The method of evaluating an investment where the investment to be undertaken or that is being evaluated is going to impact on the business risk and the financial risk of the entity that is considering that investment. That project is evaluated based on the adjusted present value approach. As we progress, I'm going to give you those conditions that will warrant you to use the adjusted present value approach. At this level of the ICANN professional exam, you don't expect the examiner to always tell you to compute NPV. No. You have advanced beyond that level. If examiner asks you to compute NPV, then it means the examiner is just being linear with you. Otherwise, what the examiner will just tell you is evaluate this investment, evaluate the investment, or advise so and so company as to whether this investment is worthy of being undertaken or not. These are the kind of questions you should be expecting. And if a question comes in that way, what the examiner expects from you is that you look at the surface of that question and be able to fish out from there whether the NPV approach or the adjusted present value approach is the more appropriate method of evaluating such investments. Okay. I am going to tell you tonight the difference between these two and situations where you are going to use one instead of the other. We are going to say that. So let me continue with the lecture. We said that the adjusted present value approach is used when a company wants to undertake an investment, and that investment is going to impact on the business risk and what? And the financial risk of that company. When you have such investment, then adjusted present value is the more appropriate way of evaluating it. Now, what is the decision rule under the adjusted present value approach? The decision rule is that undertake the project if the adjusted present value of the project is greater than 0. Okay, is greater than 0. Or let me put it as greater than or equal to 0. If the adjusted present value of the project is equal to 0, it simply means that the project broke even. If, however, the adjusted present value of the project is greater than 0, it means the project is profitable. Hence, it will add more value to the shareholders' wealth. Okay, so that is the decision rule. You will see that the decision rule of the APV is exactly the same with the decision rule under the NPV approach. Okay, so that is the decision rule. Now, what is the component of the APV? When a question asks you to compute APV, what should be the various items you need to compute? That is what we call the component of APV. Now, the APV is given as, look at the formula down there, APV is equal to base case NPV plus present value of finance effect cash flows. That is the formula for adjusted present value. That is the formula for adjusted present value. Base case NPV plus present value of finance effect cash flow. Okay, what do we mean by base case NPV? And what do we mean by present value of finance effect cash flow? Now you will see that the APV is now grouped into two, right? The base case NPV, PV of finance side effect cash flow. Okay, it therefore means that whenever you are computing APV, you are computing two different items, which is the first, base case NPV, the second, present value of finance effect cash flow. Now let's take them one after the other. The base case NPV. The adjusted present value approach try to separate finance from investment. It tried to separate what? Finance from investment. For every project that a company wants to undertake, it is possible for us to distinguish between those cash flows that will arise as a result of undertaking that project. That is solely as a result of undertaking the project. What do I mean by this? If you are to undertake a project, you will expect that that project generates revenue. you will equally expect that you are going to spend on that project. Okay, whether in form of variable costs, your fixed costs, even your capital allowances, your working capital. Okay, all these are cash flows that will arise as a result of undertaking that project. The cash flow is peculiar to undertaking that project. The moment you undertake that project, these cash flows will come up. That is what we mean by what? Specific to undertaking that project. Now, the second one, which is what? PV or finance effect cash flow. The finance effect cash flow will arise solely as a result of the method of financing the project. I don't know if you people are getting me. Let me see if you are with me. Let me see if you are with me on this platform, because this particular topic is very, very important. It's a very, very important topic. So I want everybody to be up and doing, and make sure you understand every bit of what we are discussing. Okay, thank you. Thank you. Now let us continue. I said PV or finance effect cash flow is computed using what? PV of, sorry, is computed using cash flows from finance side of the project. And what do I mean by this? Assuming I want to undertake a project, and the project, I don't have sufficient fund to embark on that project, but I have someone, perhaps my banker, who is willing to lend me money in order to finance that project. If the bank gives me money, there are some cash flows that will come up as a result of the fact that I have borrowed in order to finance that project. And what are these cash flows? You'll be talking of majorly the interest element on that loan. So that interest, I'm using interest as an example. We have so many other cash flows which we are going to look into here. Excuse me. Now, the interest payment is coming up as a result of the method you have used to finance that project. Can you see? Had it been that you did not borrow money to finance that project, you are not going to pay interest. If I have my money and I've invested it on that project, will I pay that interest? No. So that interest is classified as finance effect cash flow because it is coming up as a result of the method of financing that project. As a result of me borrowing to finance that project, that is what is causing that what? That interest. Are we together? So all those cash flows that will come up as a sort of financing that project might include your issue cost, your interest, okay, your net service or subsidy. Don't bother yourself on this grammar that I just said there. I am going to treat them one after the other, and everyone on this platform is going to understand it clearly well. Okay, so I just mentioned it. I have not treated it. So just hold on in that regard. Please excuse me. 10 seconds. Let me just take water to clear my throat. Okay. Sorry about the short break. Now, that's what we call finance effect cash flow. Okay, that's what we call finance effect cash flow. Now, let me now go back to the first one. We'll take one by one now. The base case NPV, how is it computed? I want to believe you are all with your pen and your jotter. Okay. Now, from Ejanusi, you said what of opportunity cost of using the fund? Now, the opportunity cost of using the fund is not limited to APV. Okay. Even though you are evaluating an investment using the NPV approach, opportunity cost can still come up. So it is not a cash flow that is specific to APV. So I am not treating it separately. Did you get that now? It is a cash flow that can come up whether you borrow to finance the project or you are financing that project from internal source of finance. So I am not treating that cash flow as a separate element because it's not specific to what? To the APV approach. Thank you. Let us continue. Now, the APV approach, how is it computed? Permit me to share my Excel screen so that I can show you some vital things that you need to know. We are coming back to this question. Give me some minutes to share my screen, Excel screen, so that I can show you some things, okay? 1 minute, please. Give me 1 minute. Give me some minute, please. Okay. Yeah. I want to believe that you can see my Excel screen clearly. I want to believe that. Okay. The reason why I open this Excel sheet is for me to tell you or to show you the procedure to follow where you want to compute your APV. Now, I want to start with the computation of the base case NPV. I want to compute the base case NPV, for instance. Base case, base case NPV, don't forget, that's the first one you need to compute. Base case NPV. Now, for me to compute my base case NPV, number one, I need my base case cash flow. I need my base case cash flow. Okay. After sorting my base case cash flow, how do you sort your base case cash flow first? Your base case cash flow is what I've explained earlier, but for the sake of emphasis, I will tell you again. They are your cash flows that is specifically associated to that project. That is, the moment you have decided to undertake that project, you are going to incur those cash flows. We call them base case cash flows. Examples are revenue, your cost of sales, your specific fixed cost, your working capital, capital allowances, and tax on profit, and so on and so forth. They are cash flows which are regarded as what? As base case cash flows. All right. After getting your cash flows, then you know you need to discount. Now, what cost of capital do I need to discount that cash flow? That is where the issue is. So please bear with me here. Bear with me here. Be with me here, rather. Okay. Be with me here. Now, for you to discount, we need a discount rate. Discount rate for discounting base case NPV. Now, The discount rate you need is what we call the cost of equity ungeared, or we call it unlevered cost of equity. I am going to explain it. Don't panic. When you hear cost of equity ungeared, you don't need to panic. Okay. What do we mean by cost of equity ungeared? When we're doing cost of capital, I gave you two types of beta. Isn't it? I gave you two types of beta. One is beta of equity. The second is beta of debt. Sorry. Equity, beta of asset, I wanted to say. Okay. The second be what? Beta of assets. So we have equity beta represented by what? BE, and we have the asset beta represented by what? BA. The asset beta measures, okay, let me start from equity beta. The equity beta measure what? Business plus financial risk. This is what equity beta measures. What about the asset beta? The asset beta measures only business risk. It measures only business risk. Okay. Now, a company that is having both equity and debt, please be with me here. A company that is having both equity and debt, we have beta of equity. That is, the shareholders of that company will be facing two different types of risk, which is business risk, and is the risk that is applicable to all the companies in that industry in which the company operates. While financial risk is the risk attached to the level of gearing of the company. Do you understand? It therefore means that a company that is not having debt, a company that is not financed with debt, that is, the company is financed purely by equity, we face what? We face business risk alone. Since I am not having debt, I am not going to be geared. And the moment I'm not having geared, the moment I'm not geared, then I am not going to have gearing issue. That gearing issue is what is measured by financial risk. A company that is not having debt is not going to have gearing issue. And as a result of that, the company is not going to face financial risk. Do you understand? Now, the idea is this. If I want to undertake a project, and that project I want to undertake, I am not going to take additional capital to finance that project. That is, I am not going to issue new equity, neither am I going to issue new debt. What does that mean? It means I'm going to finance that project from what? Internal source of finance. That internal source of finance basically is what? Is your retained earnings. Retained earnings. So if I'm financing the project from retained earnings, it means that I am not going to take additional capital, isn't it? So the moment I am not taking additional capital, it means that project I want to finance is going to what? Is going to face only business risk. I believe we are getting the idea now. The moment I'm not borrowing and I'm not issuing equity to finance that project, it means my current gearing is going to be the same gearing I'm going to face if I undertake that project, isn't it? Therefore, the project is not changing my what? is not changing my my gearing. So it means the project will be evaluated based on only business risk. Okay. Now, when you come to this side, base case cash flow, you will see that all the base case cash flows, there is no one that is associated with finance. Isn't it? There is no one that is associated with equity, and there is no one of them that is associated with what? With debt. So what does that mean? It means those cash flows, they are cash flows that is associated with only business risk. Please try and get the link. Try and get, you can see that is the reason why I'm taking my time to explain it to you. Okay, that is the reason why I'm taking my time to explain it to you. I will repeat it again because I want everybody to grab it. Now, I said, if a company is financed by equity and debt, the company will be facing two types of risk, which is business and financial risk. And the beta that measures business and financial risk is beta of equity. If, however, a company is having only equity, all equity finance company, it means that the company will not be facing problem of gearing. So it means the company will not face financial risk. The only risk the company will be battling with is business risks. Okay? The company will only be battling with only business risk. And the beta that measures business risk is what? Is beta of asset. I am now saying that if I want to undertake a project, and that project which I want to undertake, I am not going to take additional equity. Neither am I going to take additional debt in order to finance that project. What does that mean to me? It means the project I want to undertake is not going to change my gearing. My gearing will only change if I want to take additional capital. Since I'm not taking additional capital, my gearing will remain the same. It means that the project I am undertaking is not having any impact on my gearing. Okay? The project I am undertaking is not having any impact on my gearing. Do you understand that? So if the project is not having impact on my gearing, then the project will face only business risk. Do you understand now? Now, if you now go to our base case cash flow, the one I highlighted here, the base case cash flow, if you look at all those cash flows, there is no cash flow that is coming as a result of finance, Abi. So it means that there is none of those cash flows will face financial risk. I believe you're getting it. None of those cash flows will face financial risk. So it means the only risk they are going to face is what? Is business risk. And business risk is measured by what? By beta of asset. If you use beta of asset to compute cost of capital, the cost of capital that will come out is cost of equity on geared. Do you understand? It's cost of equity on geared. Okay. Therefore, it means that for you to discount this base cash flow, the cost of capital you need is what? Cost of equity of an ungeared company. That is what I put in there. Cost of equity of an ungeared company. That is the cost of equity that you need. That is the cost of equity that you need. I believe you got that logic now. I believe you got the logic, Abi. I believe you got the logic. Now, before I proceed, I don't want to assume that you got the logic anyway. So I still need to ask you, did you get that aspect of this topic now? Did you understand now? So it means that for you to get base case NPV, you need to get your base case net cash flow. and discount it using cost of equity ungeared. The reason being that those cash flow will only face business risk. They are not facing financial risk. So the appropriate cost of capital you are going to use to discount that cash flow supposed to be cost of capital that will exclude financial risk. And cost of capital that is excluding financial risk is cost of equity ungeared. Okay, it's cost of equity ungeared. No, Mr. Dotun, you are not using asset beta to discount. Asset beta is not cost of capital. Asset beta is only used to compute cost of capital. What you are going to do is this. I was still coming there, but let me just mention it now. When you get your cost of equity, sorry, beta of asset, when you get your beta of asset, you now make reference to your CAPM formula. Don't forget, for you to compute, when you have your beta, I want to compute cost of equity. What method do I ask you to use? I say you are going to use CAPM, which is capital asset pricing model. Okay, capital asset pricing model. So what you are going to do is you just go back to your CAPM rate. You say risk-free rate plus what? Plus beta of asset. Okay, sorry, risk-free rate plus beta of assets into bracket market return, which is RM minus what? Minus risk-free rate. So you will go and put that asset beta in this formula to get cost of equity of an ungeared company. So that cost of equity is what I'm going to use to discount this base case and base case cash flow. Is that taken? So that's what I'm meant to do. That's what I'm meant to do. Student, please, can you confirm whether you can see my screen clearly? Can you confirm whether you can see my screen clearly? You can't see my screen. What is going wrong? You can't see, but you have not, you didn't raise it since. Okay, you can see the Excel sheet. It's what I wrote that you cannot see, right? Okay, if that is the case, don't worry, I know what to do. Let me just increase the font so that you can see very well. Okay, can you now see? Can you see now? Can you now see? At least I've... What's happening? Okay, let me stop sharing and reshare it again. Let's see what will happen. It again. Let me reshare it again. Don't worry. Okay, can you see it now? Can you see the Excel sheet now? And can you see what is written therein? Oh, okay, brilliant. Brilliant, brilliant, brilliant. Thank you. Thank you, thank you, thank you, thank you. Please, whenever there is issue, just chat immediately so that you know I might not be able to confirm whether you are seeing my screen here or not. So you just chat me up and I will confirm whether the problem is general or it is peculiar to such a student that is that cannot see. Okay. All right. Thank you. Let us continue. Let us continue. So I said the base case cash flow will now be discounted using what? Using the cost of equity of an ungeared company. The reason being that all the cash flow here are not from finance. They are not coming up as a sort of method of financing the project because I am not issuing any debt. I am not issuing any equity to finance that project. So my cash flows are not associated with finance. They are associated with what? With the project alone. Okay, so it means they will not be subject to financial risk. Hence, I will discount them using cost of equity on GED. And for me to compute that, I will use my asset beta. I put it in the CAPM formula to get my cost of equity on GED. Okay. Okay. Okay, no problem. Okay, no problem. Now, what I explained earlier, when you could not see my screen, is the fact that we want to explain the procedure for computing base case NPV. And I said, for you to compute base case NPV, the first thing you need to do is to go and identify all your cash flows. Okay? Get all your cash flows and arrive at what? Net cash flows. The same net cash flow that you are what? You have been computing other NPV. There is no change. Okay? No any change at all. Okay. Now, when you get your base case cash flows, then you now to base case cash flows in order to arrive at what? Base case NPV. And for you to discount that, that is where I explained this. I said that when we're doing cost of capital, we identified two types of beta. One, beta of equity. Two, beta of assets. And I told you then that beta of equity measures both business risk and financial risk. What do I mean by that? If I want to measure how risky a company's equity is, let me take an hypothetical company now. Let me say I want to measure how risky it is for you to buy shares in GT Bank. You know, GT Bank shares is the most valuable shares of all the banks in Nigeria right now. Do you know that? I think it's now currently being selling at around 36 naira. If I want to measure how risky it is for you to buy that shares, what I will look at is that, okay, if you buy these shares as a shareholder, what are the risks you are going to be facing as an investor? Do you understand? Number one risk is the fact that GT Bank is operating in the banking industry, isn't it? And as such, it is exposed to some regulatory procedures that is applicable to the banking industry. So those regulations, those factors that when it occurs, it affects all banks in the industry is the business risk. A good example is the bank recapitalization requirement. Okay, the bank recapitalization requirement is a business risk that all banks are facing, isn't it? If CBN come up to them and say, okay, we want to recapitalize the banking industry once again, just like it happens in 2008 or 2009 or thereabout. If the bank the CBN want to repeat that same process, what happens? It means some bank will not be able to stand that because some banks are struggling to survive. Okay, you can see what happened to Sky Bank. Okay, all these affect all banks in the industry. And so if you put your money into the purchase of the shares of any bank in Nigeria, that investment is facing that business risk. You cannot avoid it. It is called a systematic what? A systematic business risk, because except you don't invest in the banking industry is when you will not face that risk. Do you understand? That is one. Second types of risk that you are going to face if you buy shares in GT Bank is the fact that if GT Bank is having debt, then in addition to business risk, you are facing financial risk. How? Because if GTB is not able to meet its debt obligations, debt holders, the creditors, especially the long-term creditors, can institute an action against the bank. You understand? They can institute an action against the bank and force it to go into liquidation. And we all know that if a company liquidates, who is to be settled first? Creditors. So if creditors are settled and there is not enough money to settle shareholders, what happened to your investment? Your investment is gone. That is why you are facing a financial risk. Do you understand now? Okay. I am now saying, assuming that I want to undertake a project, I want to undertake a new project, but that new project I want to undertake, I am not going to borrow in order to finance it. I'm going to another industry to undertake it. It means I'm going to face business risk, no doubt about that. But I am not going to borrow to finance that project. It means that project will not what? Will not face financial risk. Can you see that? The project will only face business risk because I'm not borrowing and I'm not issuing additional equity in order to finance that project. It means my current GRE will not what? Will not be affected. So the project is not going to be affected by GRE issue. Therefore, for me to evaluate that project, I'm going to evaluate it based on business risk alone. I will evaluate it based on business risk alone. And that is what? Asset beta. I will obtain the asset beta in the industry I'm going to, which I'm going to tell you the procedure for doing that. Of course, we have already done it, but I'm still going to repeat it. And then when you get that asset beta, come and put it in the CAPM formula. The moment you put it in the CAPM formula, you are going to get a cost of equity of a company that is not having debt. That is an ungeared cost of equity. Okay, when you get that, come back to where we have our base case NPV, our base case cash flow. Our base case cash flows, they are cash flow that is arising as a result of the investment alone. It's not arising, they are not arising as a result of how the project is financed, isn't it? Therefore, they are not affected by GRE. Do you understand now? They are not affected by GRE. Hence, I'm going to discount my base case cash flow using cost of equity ungeared. Using cost of equity ungeared. So, when you discount your cost of equity, base case cash flow using cost of equity ungeared, the NPV you are going to arrive at is what we call base case NPV. I believe it is perfectly clear now. Let me see your question if you have further clarification on that particular base case cash flow, base case NPV. Yes? Any question on that before I proceed? You can see that I'm taking is more than necessary time in order to treat this topic, because I hate my student complaining of not being able to solve questions on APV, where APV is supposed to be the simplest question that they should even what be happy of solving. That is why I do take my time to explain the concept. Okay, APV should be the simplest that of question that will come under section A for you to solve. Are we good to go? Let me see your response. Are we good to go? Are we good to go now? Are we good to go now? I'm waiting for a response before I continue. So that I wouldn't have to be dragged back again. That's why I'm asking you now. Otherwise, the moment I leave here, I'm not coming back here again. Don't worry. We are still coming to that aspect. Okay, no, you said in an APV. Okay, let me start from here. Okay, in an APV question where we were not given. Sorry, I'm still trying to look at your question. Better. How do we get? Oh, okay. If you're don't worry. I'm not going to skip that definitely. So I'm going to tell you how you get your beta of equity on JED. Okay, that is the next thing I want to treat right now. Okay, that's the next thing I want to treat. Thank you. Okay. All right. Now we have gotten the reason why we need to discount base case NPV with cost of equity on JED. Now the question is, how can we identify if the question says it's, oh, I've said that earlier. I said, hold on, I am going to make everything clear to you. Okay, Mr. Lawrence Elugbaju, don't worry. I am going to make it clear to you of how you are going to identify whether you are using APV or NPV. What I'm doing for now is for you to know how to compute it. Once you know how to compute it, I will now tell you how to identify APV question from NPV question. Okay, don't worry, we are going to do that. Now, after we have computed, we have been able to establish that how to compute our base case NPV. Now the question is, the asset beta you need to compute cost of equity. Okay, don't even let me measure asset beta. The cost of equity on JED that you need to discount base case cash flows. How do you compute it? How do you compute it? Okay, let me call that computation of what? Let me label it as computation of KEU. KEU means cost of equity on JED. Now, to compute cost of equity on JED, number one is either the question will give you beta of equity, or two, the question will give you cost of equity of a JED company, or three, the question will give you WACC of a JED core. The question will give you, that's number four. The question will give you beta, okay, beta of asset. The question will give you one of these, not all of them. Okay, the question will give you one of these. Okay, let us take them one after the other. Assuming in the question, what the question gave me is beta of equity. Okay, on what condition will the question give you beta of equity? Now, when we're discussing project-specific cost of capital, we discuss proxy company, isn't it? We discuss proxy company. And I told you then that for a proxy company, for project-specific cost of equity, you need to compute a cost of equity for the new activity that the company wants to undertake, isn't it? And for you to do that, you need a company that is already in that industry where you want to go into for your operation. Do you understand? Okay. That is called a diversification. If a company is diversifying, if you look at the question and you see that the question is a diversification project, question, and it is APV, what you are going to do is that, number one, when you look at it and you see that it is better of equity that is given to you, the first thing is you go and look for, it means in the industry you want to start operating from, you are not yet there. You just want to move into that into that industry. And I told you that no two different industries will have the same business risk. Abi? It therefore means that you are going to face a new business risk in that new industry that you want to go into. Therefore, since you don't have anything there, you need to what? You need to look for a company that is already in that industry. That is what? You look for a proxy company. Now, the proxy company is the one that will be having that cost of equity. Sorry, I said cost, Abi. I wanted to say better of equity. Better of equity. Excuse me. Better of equity. So when you get a company that is already operating in that industry, obtain the better of the company. Do you understand? When you obtain the better of the industry, of the company, rather, the better of equity is GAW. It means that that company, from where you have obtained the better, the company is having debt. But I am not interested in the financial risk of the company. I only want to get the business risk of the industry. And since all the company in the industry will face that business risk, what will I do? I will ungear the what? I will ungear the better of equity. I will ungear the better of equity. I will ungear the better of equity. Why am I ungearing it? I'm ungearing it because I want to remove that proxy company's financial risk from it. When you ungear, what you are going to get is what? Is better of asset. After you're ungearing. And don't forget, better of asset measure what? Measure business risk. It means I have removed the what? The financial risk of the proxy company. Therefore, what next do I do? I will just put that better of asset, I will put it in cap and straight. I will put it in cap and straight in order to get my cost of equity ungeared. I believe you are jotting down. Okay. That is one. Two is that the question can give you cost of equity of a geared company. Cost of equity of a geared company. Now, is it bound down to a proxy company? The question will give you a proxy company, but they will not give you better of equity. Instead, what will the company give you? The question will give you what? The question will give you cost of equity geared. Now, this is the logic. If you use better of equity to compute cost of equity, if you use better of equity to compute cost of equity, the cost of equity that could come out is cost of equity of a company that is geared. Because the better you use to compute the cost of equity is a geared better. So the cost of equity that will come out will be a geared cost of equity. Do you understand? Let me see. Question? No. Lolo, you don't need to regear. I have told you that what you need is asset beta. The moment you get your asset beta and you regear again, what do you want to get? You go and get equity beta. And I don't need equity beta. What I need is asset beta. So the moment I ungear, I will get my asset beta. So I don't need to regear. I don't need to regear it again. I'll just go straight and put it in campaign formula. So what will now come out will now be what? Will now be cost of equity ungeared. I believe that is taken. Okay. Thank you. All right. So when you compute your beta, your cost of equity using beta of equity, what comes out is cost of equity geared. If the examiner want to test you, they will give you beta cost of equity geared. You now afterward have to compute cost of equity ungeared. So if you are given cost of equity geared, what you are going to do is that you think of N and M proposition 2. M and N proposition 2. M and N proposition 2 is the one that is giving us the relationship between a cost of equity of a company that is having debt and cost of equity of a company that is not having debt. Do you understand? Ahmed Munir, you said in the previous one, we reject it. Why? Have I ever solved a PV question with you on this platform? I need answer to that. Have we ever solved a PV question on this platform? Hello? Can I get your response? I want to believe the answer is no. So where do you see? So where did you now see the one we previously did where I reject? I don't understand. So this is the first time I'm discussing APV with you. I have never solved any question on APV. So I didn't know where you see the one you said we previously reject. No, I've not taught you that. I've not taught you that. Okay. So the MM proposition 2 is the one that is what? Giving us the relationship between the cost of equity of a company that is having debt and cost of equity of a company that is not having debt. So what is the relationship? The MM proposition 2 tells us that a company that is having debt, the cost of equity of that company is a J cost of equity. So cost of equity jet, it says that it's equal to cost of equity on jet plus open bracket cost of equity on jet minus cost of debt, minus cost of debt, close bracket times value of debt, market value of debt, 1 minus tax rate, 1 minus tax rate, all over market value of equity, and put it as A. This is M and M proposition 2. So I don't think I'll go back to this question again, because before I left that part, I said it specifically that ask a question before I move forward. You understand? Please, because that will amount to dragging us back now. You understand? It amount to dragging us back. We don't have enough time. After this week, we have 2 weeks left and a lot of things to cover. That's why I said then, I waited for about 3 minutes. I said, if you ask question, if you have any question, ask it now. Now I have passed that place now, then I'm going back again. it's not too good for our progress, please. It's not too good for our progress. That's why I do give space for you to ask your question where you are not clear. Okay? You say, why do we need to ungear at all times? If yes, when do we ungear? And I think that is the first thing I mentioned here. That is where I firstly distinguish between what? Between better of equity and better of asset, right? I say better of asset is for a company that is having debt and equity combined. Sorry, better of equity rather. For a company that is having debt and equity combined. While better of asset is for a company that is having only what? Only equity. Now, if you want to compute base case NPV, you need what? You need cash flows that is associated with only finance. And it means the cash flows we are going to use is not going to be cash flows that will come up as a sort of you taking debt or you taking equity to finance the project. The only cash flow that you need to compute base case and NPV is the cash flow arising as a sort of what? As a sort of the project you are undertaking, not as a sort of financing the project. Therefore, the discount factor or the discount rate I need is the discount factor that what? That will not be affected with gearing as well, because my cash flows are not affected by gearing. Therefore, which of this better is not affected with gearing is better of asset, Abi? So I will use that better of asset to compute my cost of equity ungeared. My cost of equity ungeared is not affected by gearing. That's why we call it ungeared cost of equity. So I will use that cost of equity to discount the base case cash flow in order to get my base case NPV. I am now saying that cost of equity ungeared, how do you compute it? And that is why I listed 4 different approaches here. I said, is either the question give you better of equity or cost of equity geared or work of a geared company or better of asset. These are the 4 items the question can give you. It cannot be more than this. It cannot be more than this. Okay. If they give you better of equity, will I go and use my better of equity to compute cost of equity? No. The reason being that the industry I'm going there for the first time because I'm diversifying. If I'm currently in the education industry and I want to move to financial service, it means I have to get a company that is already in the financial service industry. You understand? When I get the company, I will regard that company as my proxy company. I will now collect the better of that company. If the company is having debt, that better I've taken from that company will be better of equity. If the company is not having debt, that better I've taken from the company will be a better of asset. Now, let me assume that the company is having debt. So I will come to number 1. It means the better is what? Better of equity. Therefore, what do I need? I need better of asset. I will ungear it. So when I ungear it, I will get what? Better of asset. And when I get my better of asset, I will come and put it in the CAPM formula straight. I think I wrote out the CAPM formula before. Okay, maybe I've erased it. Okay, this is it here. I put it in CAPM formula. I get my cost of equity ungeared. You only ungeared if you are given better of equity. You only ungeared if you are given better of equity. That is the only reason where you are on journey. If they did not give you better of equity, where are you on journey? There's no reason for you to on journey. I believe you are getting me. The person that asked that question. Okay, so if what they gave you is not better of equity and is cost of equity geared, that's where I'm saying you have to go back to what? Capital structure theory. I believe you should have studied that. Capital structure theory. In capital structure theory, we have the traditional theory, we have the theory, we have the pecking order theory. The one that is relevant to us here is theory. The theory is giving us three propositions, okay? Three propositions with respect to capital structure. It says we have proposition 1, which deals with market value of equity, market value of the firm. We have proposition 2, which deals with cost of equity, and we have proposition 3, which deals with WACC. Now, because I'm dealing with cost of equity geared, I am given a cost of equity of a proxy company who is a GA company. And what cost of equity do I need? I need cost of equity of a company that is not geared. Obviously, I will go and use proposition what? Proposition 2 in order to get cost of equity on geared. You can see that I have cost of equity on geared there. It's relative cost of equity geared with cost of equity on geared. I will simply make cost of equity on geared the subject of the formula. But I'm not going to do that here. I'm going to do that when we start solving question. So if what they gave you is cost of equity geared, you have to think of using proposition 2 theory. That's all. Okay. What about if you are not given better of equity? You are not given cost of equity geared, but instead, what the question give is WACC of a geared company. If the question give you WACC of a geared company, then you have to think of using proposition 3. Proposition 3 is the one that deal with WACC. And how does it set it? It gives the relationship between WACC of a geared company, that is the weighted average cost of capital of a company that is having debt, is saying that it's equal to 1 minus open bracket 1 sorry, excuse me, let me reset that formula. WACC of a geared company is equal to WACC of an ungeared company into bracket 1 minus tax rates dt, okay, all over equity, that is market value of equity plus market value of debt. This is proposition what? Proposition 3. Now, a company that is not having debt, get me clearly, a company that is not having debt, we have what? We not have cost of debt, Nabi. Therefore, the company that is not having debt, we only have cost of equity. Do you understand? A company that's not having debt, we have only cost of equity. And that cost of equity is what is going to represent the WACC of that company, because the company is not having debt. So it is only cost of equity that the company will have. And that will represent the what? The WACC. Okay? Now, that is what we have here as what? WACC of geared. What I'm saying is that WACC of an ungeared is equal to what? Is equal to cost of equity of an ungeared company. They are the same. Because if I am not having debt, I will have what? Cost of equity, Abi? So my cost of equity is going to be the same thing as my weighted average cost of capital because I am not having debt. Do you understand? So is trying to relate work of a company that is having debt with work of a company that is not having debt. And this is the formula given by Okay. Let us continue. So when you are given work of a J company, if the processing company, they give you the work of the processing company, and you now want to compute work of your own company to use that you will use to discount the what? The base case cash flows. Then you need to use preposition 3. Okay? You need to use preposition 3. And this is the formula right there. Don't worry. I'm going to make use of some of this, especially the beta and the cost of equity geared approach. Now, that is 3. Number 4 is the simplest. Number 4, if they give you beta of asset, you don't even need to do anything at all. You understand? Just put it in the capital straight. No ungearing, nothing. Just go, because you have already gotten your what? Asset beta, Abi? So if what they give you is asset beta, just put that asset beta into the capital formula, and you get your cost of equity of an ungeared company. Ladies and gentlemen, these are the 4 ways of computing your cost of equity ungeared. So let me take your question before we progress. This is all what you need to know about computation of base case NPV. The moment you know this, then the base case NPV aspect of this adjusted present value is solved. Okay, I'm waiting for your question. I'm going to give you like 2 minutes. I'm going to give you like 2 minutes for you to ask your question so that we can go to the next. Question. I'm giving you 2 minutes for your question. 2 minutes for your question. I'm waiting for a question. I'm waiting for a question, please. Minutes. 1 more minute for your question. All right. In the absence of any question, then let us proceed. Let us proceed. Now, I've sorted the base case NPV aspect of APV, with present value of what? PV of finance. What's happening? Sorry. PV of finance effect cash flow. PV of finance effect flow. They are all cash flows that will come up if you have to take additional capital in order to finance that project. For instance, if I want to undertake a project of 10 million naira and I don't have up to 10 million naira, perhaps I'm having like 5 million naira, I now decided that, okay, I want the balance of 5 million naira. I want to raise it by issuing additional equity or a combination of additional equity and additional debt. That singular act of mine will lead to some cash flows that will come up aside the cash flow that I will generate from the project. Those cash flows are what we regard as what? As finance effect cash flows. All those cash flows that will arise as a result of the method you have used to finance that project, we call them finance effect cash flows. Let us look at these cash flows one by one. Issue cost. We have the issue cost. What do I mean by issue cost? If I want to issue equity to the public for subscription in order to raise more funds, it's not for free because I'm going to make publications in the newspaper, isn't it? I'm going to pay for legal fees. If I want to issue it through the issuing house, I'm going to incur costs associated with what? Going through the issuing house in order to issue my what? My equity. The same thing applies to what? The same thing applies to debt. Therefore, if you are issuing additional capital in order to finance your project, there is every likelihood that there is going to be what? Issue cost. That issue cost is not part of the finance. Don't forget, it's not part of the finance. That issue cost is coming up as a result of the method you are using to finance that project. It's not part of the financing investment cash flow. No, it's not part of the investment cash flow. It's part of the financing what? Financing cash flow. Okay, it's breaking. All right, another network. Give me like 2 minutes, please. Let me go to change to another network, whether that one will be better. One minute, please. I'm trying to reconnect to another network so that we can. The network seems bad. The network seems bad, but let's try it. Are we okay now? Are we okay now? Is it stable now? Is it stable now? All right, thank you. So that issue cost is coming up as a result of you raising additional capital to finance that project. Do you understand? It's not part of the investment cash flow. So that is the APV approach. APV will separate finance from what? Investment. It will look at the two as being two different cash flows. It will separate cash flow from financing from cash flow from investment. That's what APV does. Okay. Now, that is one. Issue cost. Abi? Issue cost. After issue cost, two. You can have tax saved on issue cost. Tax saved on issue cost. What do you mean by tax saved on issue cost? Tax saved on issue cost will arise if issue cost is allowable as a charge against profit. If issue cost is allowed for you to be treated as a business expense, then they are going to be what? Tax saved on issue cost, because the issue cost will reduce your taxable profit. And the moment it does reduce your taxable profit, it means your tax will be lower. Do you understand? It means your tax will be lower. So you can have tax saved on issue cost, which is another what? The second type of financing cash flow. Number 3, if you finance the project using debt, there's going to be tax saved on interest. Tax saved on interest. There's going to be tax saved on interest. This will come up only if you have financed that project by raising additional debt. If you have financed the project using equity, then that tax saved on interest will not come up. Do you understand? Okay. That is a finance cash flow as well. Number 5. Number 4, Abi. Net savings on subsidized loan. Net savings on subsidized loan. Net savings on subsidized loan. Now, what is subsidized loan? Before we look at net savings on subsidized loan, you can have 2 types of loan. Normal loan and what? Subsidized loan. Subsidized loan. Normal loan and subsidized loan. What is normal loan? Normal loan represents the loan that you take. It is taken from where? From your normal source of borrowing. Normal source of what? Normal source of borrowing. If you go to your bank, to borrow a bank, the bank rates, the bank Let me change to another network, please. One minute, please. Okay. I believe we are good to go now. I believe we should be good to go. Okay. Are we okay now? At a commercial borrowing rate. Can you hear me clearly now? Hello?
We can hear you.
All right, thank you, ma'am. Thank you, ma'am. So we are taking that loan at what? At a commercial borrowing rate. That is called a normal loan. On the other hand, you might want to undertake a project and the government has a keen interest in that project which you want to undertake. In that case, government can say, okay, come, we are going to give you part of the finance we require for this project in the form of loan. But that loan, we are going to give you at a reduced rate. The moment you are receiving that loan at a reduced rate, it becomes a subsidized loan. So taking from what? From a subsidized, okay, from taking from other sources at a subsidized rate. At a subsidized rate. So these are the two types of loan you can have. Now, okay, question, excuse me. Okay, let us continue. Now, let me say, for you to borrow from your normal source, you can borrow at, let me say 8%. You can borrow at 8% if you want to borrow from your bank. But government want to give you that loan, subsidized. You want to give you at what? They want to give that loan at, let me say 5%. You can see that you are receiving what? Subsidy. So what should be the subsidy? The subsidy will be 3%, which is 5 minus 3, 8 minus 3, right? Okay. What we will say, oh, thank God, I am saving 3% interest, right? That is what we say. You are saving 3% interest. But are you actually saving 3% interest? No. The answer is no. Who can tell me the reason? Why are you not saving 3% interest? Yes? Now, you are not saving 3% interest. The reason being that instead of you to pay 8%, if you pay 8%, you are going to pay a higher interest. And by the time you pay a higher interest, your taxable profit will reduce. And when your taxable profit reduces, your what? Your tax will also reduce. Okay. But now that the government has given you the loan at 5%, you have paid less interest. So your taxable profit has increased. And the moment your taxable profit increases, what happens to your tax? Your tax will also increase. It therefore means that this interest that you think you are saving it, but you are not saving everything because you are paying tax on it. The moment it becomes a savings to you, you are going to pay tax on that savings. So what you are saving is just 3%, is just 3% into bracket 1 minus tax rate. This is what you are saving. You are not saving the 3%. This 3%, 1 minus tax rate, is what we call the net subsidy. So you get that rate, use it to multiply the subsidized loan. You get your net savings on subsidy. These are the four types of cash flows that you can have in finance effect side of the APV. All right, have we identified this? Now, how do we compute all this? How do we compute them? Okay, that is what gives students issue in this course, not the base case NPV, not the base case NPV. And however, this is not supposed to give you issue at all. I am going to give you a template, and that template is all you need to follow in order to successfully complete a question on APV. Okay? And what is that format? Let me take it one by one. Format for computing base case, finance effect cash flow. Finance effect cash flows. We want to see the format. Number one is that you have to look at the amount you will require in order to undertake that project. We call it the finance requirement. The finance requirement. Look for what is the total amount you are going to need in order to finance this project. When you get that total, divide that total into the sources you want to what, from where you want to get that finance requirement. So I can divide it into what? Equity. If I want to issue equity, I will say equity. It will have a percentage. Let me say 30%. I will use 30% to multiply the total. I will get the amount needed to be raised from equity. Then I will say normal loan. Let me say my normal loan. Let me say my normal loan is let me say my normal loan is let me say 40%. Okay, let me call it 50%. My normal loan. I want to get this loan from my normal source of borrowing, and the proportion I want to get is what? Is 50%. And the next one is what? Subsidized loan. I want to equally get the balance from subsidized loan, and the balance is 20%. Now, the question will give you the percentage of each of these sources of finance. The question will give you the percentage of equity, the percentage of debt, which is normal loan, and the percentage of subsidized loan. It must not be it must not be from the government. If your bank is giving you the loan at a reduced rate, so far is below the commercial borrowing rate, it is a subsidized loan. Do you understand? So far it is below the commercial borrowing rate in the market, it is a subsidized loan. So it must not be from the government. Okay, so it must not be from the government. Okay, let us continue. So the question will give you the percentages that they want you to use to divide the gross finance required. Is that taken? Okay, number 2, tax saved on issue cost. Tax saved on what? On issue cost. Tax saved on issue cost. Tax saved on issue cost. Let me just make this one a bit wider. Tax saved on issue cost. Now, what will you do? You will just, okay, no, not tax on issue. I've not computed the issue cost. The first is, okay, let me just insert. Let me insert, let me just move it down. That is not the next one. I've not computed the issue cost itself. So let me move this one down. Now I will say this is 3 now. We are coming there. This is 2. Now, number 2 is to compute your what? Issue cost. That is, if the question tells you that issue cost is tax allowable, the question can tell you issue cost is not tax allowable. If issue cost is not tax allowable, it means the step 3 will not be what? Will not be necessary. Okay? So if there is issue cost, there are 2 ways you can sort your issue cost. Number 1, let me call it A. A is that the question can tell you that issue cost is on gross finance. Issue cost is on gross finance. Okay? Issue cost is on gross finance. If issue cost is on gross finance, what it means is that they can give you percentage for this. Maybe issue cost on equity 2%, issue cost on debt, so normal loan 3%, issue cost on subsidized loan 1%, or they can tell you issue cost on equity is 2%, but for the both normal and subsidized is 2%. Or they will tell you, they just tell you issue cost without telling you whether it is for equity or for debt. If they just tell you issue cost, then you assume that that issue cost we appear to we apply to the 3 at the same time. Okay, so if it is on gross, this is what we are going to do. Your issue cost will be percentage issue cost. Percentage issue cost. Please, I believe I'm not sending this, if you know you need it, just have your jotter and be jotting it as I'm writing it. Because the moment I'm not even saving it at all. The moment this lecture ends, I'm going to close it. So there will not be, I don't want to be receiving requests. Send that sheet to us. Send that sheet to us. It's not available for sending, please. If you need it, as I'm putting it here, please take it down in your jotter. Okay, let us continue. Issue cost, I said percentage issue cost, all over 100% minus what? Minus percentage issue cost. You now say times what? The amount of finance times the amount of what? Amount of finance. This will give you the issue cost. This will give you the issue cost on that capital. B. Okay. B is when the question just tells you you have an issue cost, but the question did not tell you is what is gross. The question just tell you is what issue cost. With the key word there is what is the gross. The moment there is no gross in the issue cost, this is what I'm going to do. Just say percentage issue cost multiplied by the amount of what? The amount of finance. The amount of finance. That's all. That's all. So you can see the difference between the two. This one is when it is gross. You have to look at the tune of the question. The moment you see issue cost is on gross finance required, you are using the first formula. But if the question just say issue cost is 2% without gross, you are using the second formula. Please get it right. So that by the time I start using one instead of the other, you will not be confused. Okay. Now, that will give you the issue cost. That is step 2. Step 3, tax saved on issue cost. Your tax saved on issue cost, tax saved on issue cost will be equal to the issue cost in 2 above. Issue cost multiplied by what? By the tax rate. Take the issue cost we have computed in step 2 and multiply by the tax rate. That is the amount of tax you are saving as a sort of issue cost. That is if the question tells you that issue cost is tax allowable. If issue cost is not tax allowable, please, you are not charging tax saved on issue cost. Please take note. Please take note of that, okay? Take note of that. Now, when you are done with step 3, you cannot come to step 4. What is step 4? Is tax saved on interest. Tax saved on what? Tax saved on interest. Tax saved on interest, sorry. Tax saved on interest. How do you compute your tax saved on interest? You will compute tax saved on, compute interest on normal loan and compute interest on subsidized loan. So I will say interest on normal loan, and what? Interest on subsidized loan. Interest on subsidized loan. Sorry. Okay. Interest on subsidized loan. Now, you know how to compute that. This will be normal loan times what? Times tax rate. That is the interest on subsidized normal loan. Here will be subsidized loan times what? Tax rate. Can you see that? So that will give you 2 different figures. I will have XX here. That's the format. I will have XS here. Now, add the 2 together. I will be adding the 2 interests here together. Add it together. So I will add this. I will get my what? Interest. My total interest, let me say, is that's my total interest. I'll start calling me. How did you get XX? Or how did you get YY? XX and YY are mere formula. They are just formula to please. So don't start disturbing me with how did I get XX or how did I get YY? I will not respond. I will not respond. Okay. So it's just formula. I'm using it as what? As a format. I'm using it as a format. Okay. I haven't gotten my total interest. To get my tax saved on interest, what do I do? I will now say tax saved on interest is equal to what? Is equal to YY times what? Times the tax rate. Can you see that? That is total interest times the tax rate will give me the tax saved on what? On interest. That is all. I want to assure you, if you follow the template I'm giving to you here, there is no any APV question that you will not be able to solve, except you don't understand what I'm teaching you tonight. The moment you are able to grab this format, let ICANN bring the APV question from heaven, you should be able to tackle it successfully. Okay? So please, take it very, very seriously and make sure you have this format at hand. Make sure you have it at hand. Take APV questions after we have solved the one we have here. Take any APV questions, apply the format on them, and see whether you are going to get it or not, except you misapply it or you did not fully understand the concept, is when you can have issue. But the moment you are able to picture this format and you apply diligently, I want to assure you there's not going to be any issue for you as far as APV question is concerned. Okay, now number 5, which is what? Net savings. Net savings on subsidized loan. On subsidized loan. The next savings on subsidized loan, this is what I'm going to do. I will say normal loan rate. Normal loan rate. What is the rate of normal loan? Let me say TT. Let me use capital letter. Let me say TT. And what is the rate on subsidized loan? I will say subsidized loan rate. Subsidized loan rate. My subsidized loan rate, let me call it okay, let me call it SS. Now, by the time I deduct my SS from TT, I will get the amount of subsidy. I will get the what? The subsidized rates. That is the amount, the rate at which my loan has been subsidized. I will get it. Okay, let me call that QQ. Okay, that is my what? Subsidized rate. That is the difference. Okay, maybe I should put less here so that you understand what I've done. Let me put less there, or I just put it within let me just enclose it within bracket so that you understand that I deducted it for clarity's sake. So I deducted my SS from TT in order to get what? In order to get that QQ. So the QQ is the amount of subsidy I'm enjoying. But that is what? That is the gross subsidy. This is the gross what? This is the gross. Because the moment I'm enjoying this rate, I'm going to suffer it in the form of higher tax payment. I'm going to pay a higher amount of tax if my interest is low. Do you understand? So what will I do? I will now say net savings. My net savings will now be equal to my QQ into bracket 1 minus the tax rate. Okay, 1 minus tax rate. Now it is this rate I will now use to multiply what? The amount of what? The amount of subsidized loan. That will give you the amount of subsidy you are enjoying as a result of that subsidized loan. Are we together? Okay. Haven't gotten all this now. That is the last. These are all you need as far as APV is concerned. And as a matter of fact, it is not in most cases, it is not all this that we apply in the question. It is not all this. In actual sense, not all this we apply in the question. Okay? It is not all this that we apply. Sometimes it can even be only like 3 or even 2 that we apply in the question. You understand? But it's good that you know all this so that you are able to what? Maneuver. Whichever way the question comes up, it cannot be more than this. Okay? It can only be less than this. You see from what we are going to solve in the questions before us. Now the question is, we have gotten our cash flows, isn't it? Don't we need to discount them? You can see what we are comparing is what? Present value of finance effect cash flow, not finance effect cash flow alone. Now, what I have done here is that I have computed the finance effect cash flows. I need to discount, okay? I need to discount the finance effect cash flow. Now, how do I discount? Which cost of capital do I need to discount? That is the greatest shortcoming of APV. APV did not give us a single rate for discounting finance effect cash flow. Now, if you want to discount finance effect cash flow, please take note. You can use the risk-free rate. You can use the risk-free rate of return, or you can use the after-tax cost of borrowing. After-tax cost of borrowing, your normal borrowing, not subsidized. Is either you use risk-free rate to discount, or you use after-tax cost of borrowing. That is the rate you need to discount your finance effect cash flow. Okay, tomorrow, by the grace of God, we are going to meet by 9 to 11, where I'm going to explain to you the information you should be looking for in the question that will enable you to know whether you are using APV or the NPV. I will now go ahead and solve practical questions as to the computation of APV. Thank you very much. And we are going to drop the curtain. Okay, please, let me quickly take this question, please. We are going to get the recorded video. Don't worry. Amount of finance is the same as the total amount required for the project. Yes. You are perfectly right. You are perfectly right. You are correct. Okay. So it's time to scroll up. What do you want to copy from up? This is up. I'm up already. So we are going to meet tomorrow by the special grace of Almighty God, 9 to 11, for us to continue with our class. Until then, I want to wish you a wonderful night rest until we meet. All right. Thank you, and goodbye.